Hello everyone, welcome to our Corporate Action Series Part 2. I am Viraj Taral and today we are diving into key topic that is in the corporate finance world dividends. Whether you are preparing for interviews, gearing up for your first corporate job or simply want to deepen your understanding of finance. This video will break down what dividends are, why they matter and how they impact both companies and investor. So let's get started. First, what exactly is dividend? In simple terms, a dividend is a portion of a company's earning that is distributed to its shareholders. So when companies generate profits, they can do two things: reinvest them back into the business or share part of them with the shareholders. So the amount paid as a dividend is usually declared by the company's board of directors. So dividends are typically paid in cash, but sometimes companies may also issue dividends in the form of additional shares of stock. So which will call stock dividends. Well, explore both in the bit more detail. So there are two main types of dividend: cash dividend and stock dividend. So let's break them down. So cash dividend. This is most common form. Here companies pay a set of money per share to shareholders. For example, if company declares a 10 rupees 10 dividend per share and you own 100 shares, then you will receive 1000 in cash. The important thing to note is that cash dividend provide direct income to investor, so making them very attractive for those who seek regular income such as retirees. Then second form is stock dividend. Now with the stock dividends, instead of paying cash, company gives you additional shares. For example, for every 10 shares you own, they may give you one more share as a dividend. So this form of dividend is often used when company wants to reward shareholders without depleting its cash reserves. So it can also signal that company believes its stock value will rise and giving shareholders an incentive to hold into their shares. So why do companies pay dividends? Well, for starters, it is sign of financial health. So when companies consistently pays dividend, it sends signal to its investor that company is profitable and has stable cash flow. It's also a way of companies to attract more investors. So dividends are particularly appealing to institutional investors like mutual fund or pension fund that seek regular income. Now, here is something important for all of you to understand, especially for interviews. So the key dates associated with dividend, this date determine who is eligible to receive dividends. First is declaration date. So this is the day the company announced that it will pay a dividend. For example, let's say 1st March is the declaration date. So on this date, company XYZ announces a dividend, let's say rupees 10 per share to be paid to the shareholder. Second date is X dividend date. So this is crucial date. You must own the stock before the X dividend date to be eligible for this dividend. So if you buy stock on or after this date, you won't receive the dividend. Let's say for example 10th March. So investor must purchase the stock before this date to the eligible for the upcoming dividend. If you buy on and after this date, you won't receive the dividend. Next is record date. So the record date is the cutoff date for determining which shareholders are entitled to receive the dividend. Let's say record date is a 12th March. So this is the date when company XYZ checks its record to identify which shareholders are entitled to receive the dividend. And the last one is pay date. On this pay date, this is the actual day when the dividend is paid to the shareholder. So understanding this date can be a big plus during the job interview. So when discussing dividend policies or when working with the client as a part of your role in the corporate finance. So another important aspect of dividend is how they affect stock prices. So when company declares a dividend, its stock price usually increase. So however, when the ex dividend date, the stock price often drops by the amount of the dividend. So this is because new buyers aren't eligible for the dividend anymore and the market adjusts accordingly. So this can be a common interview question. So make sure to understand this concept. Now not all companies pay dividend. For example, high growth companies, especially in the tech, often prefer to reinvest profit into expanding the business rather than paying a dividend. So in fact, companies like Amazon, Tesla have never paid the dividends. So don't be surprised if you come across companies that focus more on the growth and less on paying dividend. It is all depend upon their strategy. To sum up it, we can say the dividends are crucial elements of a corporate finance that you need to understand as you prepare for your career. So whether you are aiming for the role in the investment banking, corporate finance, or even portfolio management. So knowing how dividend works will give you a competitive edge. Okay, so thank you for watching. In the next episode, we will be exploring another major corporate action, stock split. So if you found this video helpful, make sure to hit that like button, subscribe to the channel, and turn the notification so you don't miss out on this next one. And if you have any question about dividends or corporate actions, drop them in the comments below and I will be happy to help you. Until next time, stay curious and keep learning. Thank you.